having me. Hello, everybody, and welcome to our SPAC Attack, a special edition of CFO Focus. I'm your host, Laura Moreno Lucas. You may know me from Pandocap, where I provide media and news updates on the capital markets, as well as IPO advisory services focused on diversity and inclusion, or maybe from my time at NASDAQ, where I was managing director in San Francisco. Our featured panelists will tell us a little bit more about themselves soon. And joining us today, we have Trent Brown, a partner at Deloitte, Stephen Stokdyk, a partner at Latham Watkins, Lars Rathje, risk management at Lockton Insurance, Frank Watanabe, CEO at Arcutis, Jon Isaacson, CFO at Lefteris, and then John Lockhart, CMO of People Media Worldwide. So during the show, I'd like you all to stay muted during the broadcast. We're going to allow for questions at the end in the chat. But to start, we're going to have Gary, our producer, unmute everybody. We're going to go around the room quickly. And if everybody could please say your name, the title of your company, and then we'll get started. All right, let's see. Change my view here so I can see everybody. There we go. I'm going to start with Michael Fontaine. Michael.
Hi, everyone. I'm Mike Fontaine. I'm the COO and CFO of Plaza Home Mortgage. We're an independent mortgage banker, and I am located down in Cardiff, California.
Thanks, Michael. Bev, you want to go next?
Sure. Bev Wiesen, Apex Executive Search. We recruit across the VP and C level.
Great. Thank you. Patrick McGoffin.
Hey everybody, I'm Pat McGowan. I'm the COO and CFO at Sonance here in San Clemente, California.
Great, thank you. Dino.
Hey everybody, it's Dino Joya with Seer Technologies. We're located here in Los Angeles.
Great, nice to see you. Joel.
Hey there, Joel Friedman. I'm the Vice President of Finance here at the Hydrofacial Company in Long Beach, California. Home here is Newport Beach, though.
Thank you. Craig Morris.
Oh, hi, I'm Craig Morris. I am a recently retired partner with KPMG, and I've participated in a lot of these forums in the past and interested in hearing what folks have to say today.
Great to have you back. Craig Ensley.
Hi, I'm in Santa Barbara. I'm actually running a board and advisory consulting company. I've been CEO of 3 technology companies, and I'm here because I really want to understand for the benefit of the firms I'm helping what the opportunity with SPACs is.
Great, thanks for joining us. Gerhard.
Gerhard Apfelthaler, Dean of the School of Management here at California Lutheran University, ranked number 9 by US News and World Report.
Awesome.
Good to see you.
Good to see you. Antonio.
Hi, everyone. This is Tony Rodriguez. I'm the CFO of the Books Company. We're here in Southern California. We're the largest farm-to-consumer floral retailer.
Wonderful. Robert Purcell. Oh, you're on mute, Robert. Oh, lost you.
You lost Robert.
All right, and I encourage everybody to please turn on their cameras so we can see you. Oh, there's Robert. Robert, you back? Oh, okay, let's go to Jose. Jose.
Hello.
Hi. You want to say hello, your name, your title, and your company?
Oh, I'm sorry. I didn't hear that before. Yes, my name is Jose Zuniga. I'm the CFO at Dollar Shave Club.
Wonderful. Laird.
Hi, Laird Kagan. I've started Kagan Capital about 30 years ago. I recently started FS Medical Supplies, and I've taken 12 companies public in reverse mergers.
Awesome. Thanks for joining us. All right, Travis Lane, you're up.
Hello, I'm Travis Lane. I'm CFO at Universal Standard Housing, USH, which is a workforce housing contractor, manufacturer, and developer here in Los Angeles.
Great, thank you for joining us, Travis. Aubrey Kelly.
Hi, everyone. I'm Aubrey Kelly. I'm CEO of Rabble Health. We are a precision medicine digital health company. I'm also testing out my new podcast equipment, so hopefully I'm coming in loud and clear. But appreciate being on the discussion. So thank you.
Yeah, you sound great. Christopher Scott.
Hi, everybody. I'm the CFO for drinks.com. We are a marketing technology company focused on the enablement of ship-to-home wine, which is critically important these days.
It is. Thanks for joining us, Christopher. Carlo.
I'm Carlo Brignardello, principal with Cresa. We're a national and international corporate real estate firm representing tenants exclusively, 60 offices across the country. I'm based out of Los Angeles, locally right now at home in Thousand Oaks.
Great, good to see you, Carlo.
Great to see a lot of familiar faces.
Eric, you're up next.
Hi, I'm Eric Mulheim. Most recently, I was at BuzzFeed as their Chief Financial Administrative Officer. I'm currently in transition and advising a couple of companies based in Los Angeles, just south of Hollywood.
Nice, good to have you. Thank you. Scott Burrows.
Hi, Scott Burrows, VP of Finance at Arcutis Biotherapeutics in Westlake Village.
Good to see you, Scott. Thanks for joining us.
Hi.
Steve.
Steve Loomis, Chief Financial Officer and Chief Operating Officer for Color Science, a skincare, sun care company here in Carlsbad.
Wonderful. Jim, you're up next.
I'm Jim Eschweiler, former CEO and CFO at a couple different companies, mostly restaurant retail space, and recently co-founded a group. We're doing management contracts and advisory services and kind of mid-market type category.
Thank you for joining us, Jim. Craig Hayward.
Good evening. I am Greg Hayward. I am the CEO and founder of Trackable Health, coming to you from my deluxe server farm. So I hope everybody has a good evening and a happy holiday.
Thank you, Craig. Eric, you're up next.
Okay. The other Eric, I'm Eric Bauer. I'm the CFO of a company called International Vitamin Corporation. We're a large global nutraceutical manufacturer, private label for large food, drug, and mass customers.
Thank you for joining us. David Rofsky.
Good afternoon, David Rofsky from MUFG Union Bank. I am the Senior Relationship Manager. It's great to be here and see some old friends.
Great, thanks, David. Michael Flippo.
Hi, I'm Mike DiFilippo. I'm the CFO of Invoca, which is an enterprise SaaS company based in Santa Barbara.
Thank you for joining us, Michael. Gary Johnson.
Hello, everyone. I'm Gary Johnson. I'm the CFO of Calibre Global Energy. We just changed our name from B&K Petroleum, and I'm based in Thousand Oaks.
Great. Thanks, Gary. Brent, you're up next.
Brent Cranmer, CFO of Ball Seal Engineering, located in Foothill Ranch.
Thanks for joining us, Brent. Patricia.
Hi, I'm Patricia from the Next Level Up. I'm a CFO, consulting CFO. I support early stage companies as well as those preparing for IPOs.
Thanks for joining us, Patricia. Jim Queen.
Hey, good evening, everybody. I'm Jim Queen. I'm the CEO of Diamond Student Information System. Diamond is a 20-year-old software company that provides software to the back office, supports the administrative functions of small colleges. We support admissions, financial aid, accounting, placement, etc. And nice to be here. Thanks, John.
Thanks for coming, Jim. All right, Bob, you're up next. Bob Grieder.
Oh, Grieder, this is me. Hey, this is Bob Grieder, president at Vargo Physical Therapy, based out of Westlake Village.
Wonderful. Thanks, Bob. Kevin Harris.
Hi, I'm the former interim CFO at Muscle Farm Corporation. I'm currently consulting on my own, and I've recently formed as a co-founder and chief operating officer of Young Farms, which is a cannabis cultivator based out of Tennessee.
Nice. Thanks for joining us, Kevin. Bill Farewell.
Hi, Bill, CFO of Pete's. We're a hydroponic greenhouse grower here in Carpinteria and Oxnard, not cannabis.
You guys ought to merge, expand your market.
Stephen Finney.
Hi, I'm Steve Finney. I'm CFO of Sensor Industries in Camarillo. And hello to Eric Mulholm. Haven't seen you in a few years, Eric.
Oh, nice. Friends reconnecting. Thanks for joining us, Steve. Jesse Martinez.
Good evening, everyone. Jesse Martinez, based in San Francisco. I'm the founder of Latinx Startup Alliance, and I'm also a venture partner at Vamos Ventures and Republic.
Thanks, Jesse. Larry, you're up next.
I'm Larry Roslowski, most recently the CFO of Razor, the kid scooter company. Currently in transition, doing some interim CFO work and some project work as I look for my next great challenging assignment.
Great background. Love it.
Thank you.
Nazanin.
Hi, I'm Nazanin. I'm the CFO of Parkia. It's an engineering and construction firm. We work with utilities and municipalities. And prior to that, I was an investment banker for 24 years. Most recently had been with JP Morgan Private Bank.
Thank you for joining us.
Thank you.
All right, Francisco.
Thanks, Laura. Hello, everybody. Francisco de Bocos from Pensera. We are here in Orinda in California, about 17 miles east of San Francisco. And I co-head the investment banking division for the firm. Thanks for having us.
Thanks, Francisco. Barb.
Sorry, did you say Lars?
Barb.
Oh.
Hi, I'm Barb Bitzer. I'm the CFO of Tenacor based in Santa Ana, and we do service and repair of medical equipment.
Thanks, Barb, for joining us. Gazelle, hello. Thanks for joining us.
Hi, Laura. Long time no see. Hi, I'm Gazelle Lumpkin. Actually, in between the jobs, just recently left Procore and joining GoSide as their CFO.
Thanks, Gazelle. Shauna, you're up next.
I'm Shauna Watson. I'm a managing director at Accordion based in San Diego.
Thanks for joining us. Mark Mitchell.
Hey, how are you? Mark Mitchell with Union Bank, representing the Tri-Counties.
Awesome. Thanks for joining us, Mark. And I see Robert Purcell again. Did you want to say hello?
Yeah, can you hear me okay?
Yeah, I can hear you.
Robert Purcell, CFO, currently advising more companies than I really want to, but splitting my time between fintech and biotech, and essentially doing either due diligence, advising, or pre-IPO.
Great. So I have a lot of people here who don't have their camera on, so feel free to turn. Let's see, Rama, I think I can see you. There you go. Do you want to say hello? Oh, you're on mute.
Okay, I think you can hear me now.
Yeah.
Hey, Laura. Thanks for having me here. Hello, everyone. My name is Rama. I'm the CFO of a company called Jade Global. We are a technology services company headquartered in San Jose. I'm, of course, on the East Coast, Princeton, New Jersey. Keen, eager to learn more about this topic. This has been very interesting for us. Thank you.
Thank you for joining us. All right, let's see. Did I miss anybody? Stacy Cotto, do you want to say hello? All right. Yi Larson.
Hi, this is Yi Larson. I'm CFO at Turning Point Therapeutics here in San Diego.
Great, thank you for joining us. Jay Newman. Do you want to say hello? All right, I think I got through everybody. If I missed anybody, just ping me in the chat. We want to make sure everybody has an opportunity to introduce themselves. Adam Cohen, did I get you? You want to say hello? Okay.
Hi guys, Adam Cohen, MUFG Union Bank Senior Relationship Manager, having technical difficulties with the camera. Apologize.
Yeah, no worries, no worries. All right, well, I think that's everybody. If I missed anybody, please feel free to ping me in the chat, and I'll allow you to say hello. All right, so now let's get to the hot topic that everybody is here to learn about. It's a timely topic because it's definitely been a crazy year of new issues coming to market. So what we're talking about today is SPACs. So what are SPACs? It's special purpose acquisition companies. And what it really is a shell company that is established initially. And then what happens is they have 2 years to identify the target that they are going to acquire. And once they get their target company, then they go ahead and bring it public under the company that they established. And sometimes it stays as the name of the initial blank check company, and sometimes it can be the name of the company that they're acquiring. So that is the SPAC. We're gonna talk a lot about it. There's been traditionally a lot of people that have been doing this for quite a long time. We have some people on our panel today who have been doing this, and whether you think the outcomes of what happened last week of Airbnb and DoorDash, going public and IPOing and that pop that happened, what happens is everybody's questioning, well, what's an alternative way? What's a quicker way? What are other ways that we can come to market? And so, this process has been around for quite a long time, but it's become much more popular in 2020, I think because of the efficiencies around it. But we're gonna learn a lot about it. We're gonna have a lively discussion. And so now let's dive in. My first question goes to Trent. Trent Brown from Deloitte. We'll start with you. How much SPAC activity are you seeing in your practice in LA?
Yeah, thanks for the question, Laura. Really what we're seeing is unprecedented. And when you go back in time 4 or 5 years ago, Deloitte really wouldn't be associated with SPAC transactions because it really wasn't a traditional vehicle that companies would use to go public. And now within our Southern California practice, which I help lead, we have about 12 clients of ours that are in the process of merging with SPACs. And when you look at this year, like through September, about 80 companies have gone public through merging with SPACs. Compare that to 5 years ago, there was only about 20 companies. And there's been about more than $30 billion raised through SPAC transactions in 2020. 5 years ago, it was about 3.1 billion. So what we're seeing is really unprecedented. And, we expect this momentum to continue into 2021 and beyond. And a lot of the reasons why is because there's about 1.4 trillion of committed capital out there that private equity is trying to put to use. And also because the SPAC process takes some of the uncertainty out of the equation of going public because you negotiate the deal proceeds up front. And so, yeah, we are seeing a ton of activity in Southern California and within our audit practice. And we're getting a lot of calls from our clients, private clients that are either thinking about doing a SPAC transaction and are preparing for one.
Thanks, Trent. So John tell us why. Why now? Why 2020 has made the SPAC explosion?
That's a great question. I think we were all thinking about a year ago, people hadn't necessarily heard of COVID and people hadn't heard things like SPAC-a-palooza and SPAC-offs, which are all now totally part of today's vernacular. I think it really has to do with some legitimization. Without question, over the last, this is not a new product. It's been around for decades. It was usually viewed as my friend at Deloitte said, it was inferring almost a way to go public of last resort. And now that taint appears to have gone by the wayside, and appears to have gone by the wayside permanently, is what I would postulate. And the reasons being is, first and foremost, you have the legitimization of very large companies that had regular way IPO as an alternative going the way of SPAC. So the headline there is certainly the Virgin Galactic folks and lots of other very name brand private equity firms, very name brand managers going this way and doing it with size and alacrity. So I think that's definitely a big part as to why this has changed. And I think you're seeing managers that that were never in this space before. Now, instead of being part of a private equity firm or some other purchasing vehicle, now very legitimate folks are entering into this. So it's just a legitimization process. I think it's really as simple as that. And once it's been legitimized, now the floodgates are open.
Yeah.
Yeah.
And we had the second largest IPO ever was done this year by Pershing Square. They raised $4 billion, which is a SPAC. And it just goes to show how SPACs are being legitimatized.
Mm-hmm. Yeah, and celebrities are getting involved as well, right? You know, when celebrities start getting involved, it's legitimate.
Yeah, Jay-Z has one, as well as former Speaker of the House, Paul Ryan, is vice chairman of one. So lots of folks in that way. But I think that aside, there's highly legitimate, very backable people being involved with this now that weren't before.
Thanks, John. Lars, let's talk about insurance.
Sure.
You know, talk to us about how corporate insurance is impacted by going public.
Well, you know, it's a complex question, and if you're talking about the traditional IPO route, what ends up happening is the majority of the insurance policies that are changed are typically the D&O, so the directors and officers insurance. The private D&O insurance will go into runoff, and you have to buy a tail for that, and then you have to buy a new D&O policy, which only covers the public D&O entity moving forward. So that's kind of the major impact from an insurance perspective. And then, you know, when you're talking about the attainability of this type of insurance, it's somewhat unprecedented. It's relatively new. And from an underwriting perspective, you're typically looking for data, right? They're all kind of trying to find metrics that will help them identify what the true risk is. And so since it is so new, we're kind of waiting for the SEC to put some sort of parameters around what those regulatory requirements look like. And as a lot of you have already alluded to, you know, the number has jumped to significant amounts of SPACs in the past.
Oh, Lars, we lost your audio.
Yeah, so I mean, it's just, there's a lot of scrutiny involved.
Well, speaking of scrutiny, thanks, Lars. That's a great segue going into legal. Stephen, why don't you talk to us about the legal side of this, you know, SPACs versus IPO?
Yeah, so I've spent most of my career working on IPOs. I've worked on over, I think, about 60 IPOs right now. And I've got 2 of them going on right now, but I also have 4 different SPAC transactions. 2 of them are going to sign letters of intent, hopefully in the next 24 hours. So to definitely have gone through both processes, and there's a huge amount of similarity between the 2 processes. I think the bottom line for you as private companies is that at the end of this process, and there's some gyrations, different gyrations you'll go through each one, but you'll end up being a public company. The difference is, and you know, the going the IPO process is a well-worn path, and people know how to do it. The SPAC process is really more of a combination of a merger transaction, an IPO transaction, and a private placement, because most companies will also raise private capital, what's known as a PIPE, at the same time. So you're really doing 3 different transactions in the process. The difference is, and one of the key differences between the 2 is, in a SPAC transaction, you'll know the price up front, which is why it's attractive to a lot of private companies. Whereas in the IPO process, you don't know what the pricing is going to be till the very end of the process. But in terms of companies preparing themselves to report, to disclose everything that's relevant about the company, to deal with investors, to get out there and sell their story, because either way, whichever process you decide to go through, you're going to be dealing with investors. It's really the beginning of a process, the beginning of hopefully as a growing public company. And that's the whole goal of the sponsors and the companies themselves, is to use this as really a launching pad to make sure you raise a fair amount of money in the process, both from the SPAC, which has its money that's raised in its IPO, as well as the simultaneous private placement. So I think for you, just knowing that, yes, there'll be a similar amount of work in terms of preparing yourselves to become a public company, whichever path you choose.
Yeah, I mean, great question there, on the pricing. In the SPAC, you identify the price up front, IPO, it's at the end. And right now there's a lot of controversy on, how things are being priced. So for some, again, some people think the pricing is a discussion that needs to be had. And so that's why they choose that route. So, all right, let's move on. Jon, let's talk about branding. How do we think about this from a marketing standpoint, SPAC versus IPO?
Well, thanks, Laura. It's great to see everyone tonight. I'm Jon Lockhart. I'm Executive Vice President of People Media and Chief Marketing Officer here. And we've been working in this area for the last 20 years or so. And I think a lot of us think of SPAC as reverse merger or the Toronto Stock Exchange or something less desirable than the IPO process. And if we are communicating early on with companies, it's important to make sure that everybody understands what you're doing. And it's not just your what we consider to be your prime audience, which might be your board or your initial investors. You got to think about the audience that you're going to be working with for the next 15, 20 years. And if you're going to be acquired, or if you're going to have any kind of long-term valuation, you want to make sure that you have everything adequately explained. And if you can do good things, like we saw what happened with Airbnb last week, they were able to recognize their hosts as a key constituent and offer favorable pricing on the stock before they went out. And a lot of those people have had huge windfalls. I think they offered it at 60 and then it went over, you would know, Laura, but it's like it was 143 and then over 200, I think. So those people obviously are very grateful to the organization that they're part of. And anybody that's communicating knows you want to be long-term, you want to be storytelling well, so that over the length of time of your company's legacy and existence, you do well in that process of honoring your constituents and making sure you're communicating well with them. Back to you.
Hi guys, not sure what happened there. Well, I'm back right just in time, right? You just finished, Jon, right?
Yes, exactly.
All right, right on the dot. Okay, so now let's go to Frank. Frank, you, why don't you tell us a little bit about your journey? And I know that you just went public this year on the NASDAQ. I worked with your team, and but you chose to go the IPO route. So tell us a little bit about your background, why you chose the IPO route, and what you think about the SPAC process.
Sure. So, to be completely honest, we went public at the end of January of 2020, and I don't think the SPAC mania had really hit at that point in the game. There were certainly discussions around the board table at the time about reverse mergers, but reverse merging into an operating public entity. And I think that there was a sentiment that there was a certain taint. If you were reverse merging into a company, that was probably because that was a company that didn't have a lot more than cash on their balance sheet, and for whatever reason they were no longer a viable entity, and that made them a target for a reverse merger. I think that's a little different than a SPAC. But to be honest, there was no discussion about a SPAC at the time that we went public. I think the discussion was around reverse mergers, staying private, which was certainly an option, or doing an IPO. And the IPO, I think, was attractive from the standpoint of the cost of capital is less, and we have deep pools of capital in this country, especially on funds on indexes like NASDAQ. I think one of the other speakers mentioned the price finding function of the IPO, and I think that is really critical. if you look at our experience, we had done a crossover about 4 months before our IPO, and then going through the IPO process, we fortunately discovered that there was a lot of interest in the company, and we were probably worth more than we would have hoped to have been worth when we started the process. I think we ended up 9 times oversubscribed on the book. We were able to price at the top of the range. We were able to upsize the deal, and then we were able to exercise the green shoe. And so we ended up with this very, very large infusion of capital at a very, very attractive valuation, which frankly, we probably could not have hoped to get at the beginning of the process. I don't think it always ends up that way for everyone, but there are also companies that are able to price above the range and even revise their S1s and go beyond the 20% upsizing limit as well. So I think there is a really important price finding function to the IPO that worked to our advantage. And then, we popped 50% in the first day. And so our investors were very happy about that outcome as well. Having said that, there's a lot of pain involved in the IPO process. We were talking about this a little bit before. The roadshow is certainly painful. The preparations are painful and expensive. I spent a lot of time with Stephen's colleagues up in San Francisco at Latham, spent a lot of time with Ernst & Young, spent a lot of money with both firms. So it's not a trivial process. And so I could see also how a SPAC might be an attractive alternative route, especially given, I think, some of the comments that folks have made today about that vehicle becoming more legitimate, let's say, in the eyes of investors.
But the only thing I would add to that is that the SPAC process is definitely not cheaper, and there's also a question about whether it's even less time. So I think that the fees are probably similar, and the amount of effort is very similar to both.
Okay, haven't done it, so I couldn't comment, but yeah, that makes sense. It's. I remember the first time they showed us the budget, I was shocked at how much it was going to cost to go public, but.
Well, thanks, Frank, for sharing that with us. All right, we're going to take it back to the top. Trent, talk to us a little bit about what are some of the concerns on the accounting side or the issues that you see with SPAC transactions?
I think, from an accounting perspective, going the SPAC path, it's a little bit more complicated and difficult than going the traditional IPO path. And part of that is because once you identify the SPAC and you sign the letter of intent, there's an intense amount of pressure to get past audits done and reviews done and to get the S4 or merger proxy on file with the SEC. Whereas with your traditional IPO, the company has more control and flexibility over the timeline. And with a SPAC, oftentimes you're working with an entity that has a fuse, right? They have basically 2 years to get a deal done, and it may take a year for them to find the target. And so by the time you get the LOI signed, you may be working against the SPAC's timeline as well. And a lot of companies that are merging into SPACs, they're emerging growth companies. They've underinvested in the accounting department. And now all of a sudden you have to deal with the rigors of becoming a public company. So you got to be able to do quarterly reporting and year-end reporting, right, in time with SEC requirements. And then you have to start thinking about internal controls in Sarbanes-Oxley as well. So, one of my main concerns when we have clients that are going down this path is, do you have the infrastructure and are you ready to be a public company? And a lot of times the bankers and others underestimate the amount of time it takes to convert your old audits from AICPA audits to public company audits, right? Which is what you have to do before you can get a SPAC transaction done.
But essentially what they say is the time is shorter, right? So
it's right, it's shorter.
Mm-hmm. Yeah. Thanks, Trent. All right, yep. John I. Talk to us a little bit about, some of the concerns about when you get the SPAC combination and you go public. We've seen some issues on it trading down, or there have been some that have traded down. So talk to us about why this happens and what could be done maybe to mitigate it.
Sure, Laura. Well, actually building on the first question as to why now, I think it is part and parcel with the fact that not only were SPACs considered, if we're being blunt, the alternative of last resort to go public, many of them, the dirty little secret is, didn't trade very well in the aftermarket. Once they went public, they didn't do well, I think, for a lot of the reasons that Trent said. They were not ready. And let's be clear, this is a merger. It's not a big financing event in terms of people, excuse me, it's not a big liquidity event for folks. So how it trades afterwards is crucial and paramount. And so what I think we started to see in 2020 is, with the legitimacy of some of these very large, big, well-known named companies going the de-SPAC business combination route, with very well-known private equity firms. And now what you're seeing is operators, folks who have operated public companies successfully before. And instead of going other routes, they're going the SPAC route. And so with that, you're seeing operators who are getting involved, and they don't just go away as a quick get-rich scheme. They remain involved with the company post-de-SPACing, post-business combination. And so I think that's also adding to the legitimization of SPACs.
Thanks, John. Lars, talk to us again about the insurance side of this, and maybe more about the pricing and the cost.
Sure. Well, if you haven't already buckled your seat, do it now. This is something that, if you're not familiar with purchasing a public D&O, you are going to be quite shocked. There's been a lot of litigation in the D&O space with just in general IPOs as well as SPACs. And we're starting to see some of the transactions and the claim activity that's happening. So we're kind of keeping a close eye on the marketplace. We don't really see a huge difference in pricing between SPAC or IPO, but just to kind of give you a broad stroke spectrum, each company has to go through their own underwriting. But you're typically purchasing insurance towers of about 5 million. You're purchasing towers of 5 million. So you're kind of building as large of a tower as you need to. And you're typically starting off at around $1 million for that first layer. So it's quite expensive. And you're also looking at a $10 to $15 million retention. So we're looking at very, very, very expensive insurance. And I think the next question is, why even buy this? And, you kind of have to look at your balance sheet and say, is this something that we are able to take on ourselves and self-insure for, or is this something that we need to risk transfer to the insurance carrier?
Yeah, that's very, very large numbers. So something to think about as you're considering that. Yeah, along with all the other fees that are involved with both, either if you choose a SPAC or IPO. So let's go to Steve. Steve, how is the public company preparation process different on the legal side, SPAC versus IPO?
The preparation process is really similar, to be perfectly honest. And I think Trent covered a lot of it on the financial side, but on the legal side, as I mentioned initially, a lot of it is just preparing the company to report, to put its disclosure together, to sell its story out there to the public. Because at the end of the day, as I mentioned before, you're going to have the same type of disclosure obligations and the same type of reporting obligations you would have for just going through the traditional route. So I would say that the process itself is actually very similar. And the thing that we try and spend with companies is, look, if you're thinking of doing a SPAC and going out to reach out to them, you should really be doing about 2 to 3 months of preparation before that, just to make sure that your house is in order, your capitalization is set, that you've reviewed all the material contracts and make sure they're not going to be affected by a transaction. So all of that process, you really need to front load it, because if you have a SPAC approaching you and they want you to sign a letter of intent over a weekend, yeah, that's nice, but you don't want to have to put pencils down and say, okay, we need 3 to 4 months to get ourselves ready to go public.
Yeah, definitely.
I would maybe there was a couple questions. I mentioned fees before in terms of budget for a SPAC. Just rule of thumb that it's always been for an IPO is traditionally 10% of the money raised. So if you're $1 billion company and you raise $200 million, roughly the fees are $20 million. I think we're seeing almost similar numbers for a de-SPACing transaction. It's a little bit more of the Wild West out there right now in terms of the fees being all over the map. But I think once you break it down, I think think you can roughly think of it as approximately 10% of the amount of actual cash that you raise for the company itself.
Yeah. Thanks for sharing. Yeah, definitely all of the fees have to be accounted for. And then just going back to Lars, is the insurance for an IPO the same as a SPAC?
I was literally just replying to Eric's comment there. Yeah, so the insurance recommendations won't change. As I mentioned earlier, the D&O is your most important thing to review to see if it's worthwhile purchasing. All of the other property and casualty insurances will all stay the same. General liability, property, depending on what type of a risk you are, your product liability, things of that nature. But nothing else changes. It's the D&O that will. There's a change in control provision that enacts, and you have to then purchase a public entity D&O.
Thanks, Lars. All right, John, you're up next. Let's talk about some flashy marketing stuff and what CEOs and CFOs need to be aware of when they are on the runway to going public.
Well, the short-sightedness that we see a lot of times in we got to just get through this like it's another quarter or another year is what we try to dissuade management from following as a tactic. You want to look strategically about what this valuation is going to mean in the next 5, 10, 20 years. We've had Frank Watanabe from Amgen is now at Arcutis. We've had other Amgen executives over the last 15 years, 20 years leave and try to get financing through reverse mortgages and other things like that haven't had as strong evaluation on those companies going forward. So that's what I would definitely remind people to do. Just make sure that all of your marketing materials look great, your website looks good, your messaging is repetitive. I mean, people always need to know it's reach and repetition in the communications game, and you just got to keep it up. And it sounds like a lot. Laura, you're helping a lot of these companies on the runway to make sure they're in compliance with all their CSR and other ESG and all the other acronyms that they want to be on the right side of. So I think they just need to talk to experts like you and make sure that they're doing the right thing.
Thanks, John. Yeah, it's definitely alphabet soup, but lots to consider on the marketing and media side of things. One note to that, we were talking earlier about the fact that prior last year when I was taking companies public, from a media standpoint, you would only see the IPOs going public on NASDAQ or, for that matter, the New York Stock Exchange. And now you're seeing all of the opening and closing bells, regardless of whether it's an IPO or a SPAC. So they're giving it the same media and flash attention because it's now mainstream or legitimized. All right, let's move on to Frank. Frank, let's talk a little bit about your experience with a biotech and the cash burn is so high and needing to raise money quickly, and so all the options that you have to consider, whether it's private, public, and really how to choose that best route for you.
Okay, so a couple of different questions there. I guess on the first one, yeah, for those of you who are not in the biotech space, we bleed cash for a long time. If you look at the data for the industry, on average, it takes about 10 years from conception to approval to develop a new drug. And, the estimates of what it costs vary anywhere between $1 billion to over $2 billion before you sell a single dollar of product. So it's a very, very long, very expensive, and very risky proposition. Over 90% of drug product development projects that start never actually make it to market. And so, yeah, we go through a lot of cash. And historically, companies have probably stayed private well into their clinical development. And so they required multiple rounds of private financings. The window is wide open right now for biotechs. And so folks are being able to launch IPOs very early on. Preclinical companies are getting decent valuations that probably could not have IPO'd, even 2 or 3 years ago, particularly if you're in the oncology space, which, everyone wants to be in oncology. I wonder how many drug companies we actually need in oncology, but that is the hot spot right now. I think, we touched on it. I touched on it earlier, and I think it kind of brings together some of the streams that some of the other folks have talked about as well. I think the key question, whether it's a SPAC or an IPO or a reverse merger, is do you want to go from being a private company to a public company? And there are pluses and minuses to both of them. How you make that transition, how you matriculate from private to public, is a single point event. But what you really need to be thinking about is this journey that happens afterwards, right? All the things that, Steve and John were talking about that you have to do once you're a public company, and Lars too, the D&O, right? None of that stops regardless of how you become a public company, and the scrutiny that comes with being a public company as well. And depending on your business model and your strategy, I think you have to weigh what's the right time. If you're going to IPO, you also have to weigh what the external environment is like. And I think you also need to be thinking 2 or 3 steps ahead in terms of how much you're going to raise in your initial financing. And then when are you going to be able to do another financing? What are your catalysts that might, get to a better inflection in value? Because, you're always raising money, whether it's public or private. It certainly is a cheaper way, I think, to raise capital being a public company, but there's lots of brain damage associated with it as well. And so folks, I think, just need to go into it very with open eyes and weigh the pluses and minuses of whether they want to stay private or whether it's time for them to think about going public through any of these various avenues we've talked about.
Yeah, and just to kind of expand on that a little bit more and put you on the spot, when you think about that event and all of the different, components that happen with it, whether it's legal, audit, and all of the players that need to be involved. Since you just went through this in January, how do you actually think about getting that team together? How did you do that process, building that team for Arcutis?
Yeah. So, I think, and probably, and I'm not saying this just because this is a bunch of CFOs, but probably the single most important decision as a CEO is who your CFO is going to be. We ended up hiring a very experienced CFO who had done multiple IPOs previously. Many of you guys may know him. John Smither was CFO at Kythera, was CFO at Unity, was CFO at Sienna, was interim CFO at Kite. So he knew the ropes. And then we brought Scott Burrows, who's actually on the call with us, who was investor relations at both Amgen and Shire. So, part of our core strategy at Arcutis is finding people with very deep expertise and bring them in. We're a small company. We try and stay small. So we try and make sure that the people we bring in are exceptional. And that was the way that we approached it for the IPO. We did the same thing on the legal side. We brought in a very experienced general counsel who had done this before. And then we got very experienced external consultants, our auditors, as well as, Latham. That makes a huge difference. They know what to do. It's a fairly well-established playbook, right? It varies a little bit from company to company, but the basic blocking and tackling, I think, are the same. And so having the right people, I think, on your team, either internally or externally as advisors, are really critical, especially if you're someone like me who had not been a CEO at an IPO previously.
Yeah, thanks, Frank. I agree with you. And I know there's a lot of CFOs right now on this call specifically who are in transition that have done public company work, like Robert Purcell. Actually, I think PaySafe did a SPAC. So kudos to him. All right, let's go back just before we start getting a little bit more questions. And don't forget, if you guys have any questions, enter them in the chat. We'll switch over to answering your questions in one more minute, and then we'll wrap up here. So let's go back to Trent. Trent, so for companies looking to do a SPAC ahead of time, and in the future, what should they be thinking about?
Yeah, I've been in the accounting profession for more than 20 years. And the one thing I've learned is that timelines are fickle, right? I've had a lot of clients that say, I'm going to go public next year, and it doesn't happen next year. It may happen 5 years from now. And so what I would say is I would start, if you want to do a SPAC transaction or an IPO, invest in those things that are going to benefit you, whether you're a public company or a private company first. I mean, I honestly, I wouldn't waste a lot of money on internal controls and being Sarbanes-Oxley compliant. What I would focus on is, can you close your books in 7 to 10 days? Right. And that's going to benefit you whether you're a private company or whether you're a public company, to have quicker financial reporting. I would focus on that. I would focus on the cap table, making sure that the cap table is clean. I would invest in FP&A, right? Make sure you have a good forecasting process and a strong FP&A group, because that's going to benefit you whether you're a private company or you're a public company. And when you're a public company, you're going to have good forecasting, because you're going to have to share with the street, you know, what your estimates are. And I would also consider doing, you know, quarterly reporting as well, and making sure that you have a hard cutoff each quarter, which I think would benefit you whether you're a private company or a public company. So those are the things that I would start thinking about, you know, if that's something that a company is going to consider. You know, a lot of my clients, you know, I'm working on 3 SPAC deals right now. You know, 2 of them, it would take them 5 months to close their books. And now we have an LOI signed. You got to be able to produce financials regularly. And if you've underinvested in that, you're gonna wind up paying for it. So
yeah. Thanks, Trent. Starting that rigor early.
Yep.
Always good.
Yeah, and focusing on those things that are going to benefit you whether you stay private or go public.
Yeah, definitely. John, coming to you. All right. So there's a question in here. I might ask you this one. See if you can take it. On an IPO, might sell 20% or so of the equity in a SPAC transaction. Does the SPAC always buy 100% of the equity, or sometimes a smaller amount? What's typical?
I'll do my best there. So we have a $200 million IPO, $7 million green shoe. We may or may not use all of that. So it depends, as has been mentioned by a few of my fellow panelists. A big part of the SPAC transaction, you're going to deal with an equity player. The size of the equity actually doesn't matter as much as one might think. A $200 million SPAC like ourselves could do a several billion-dollar transaction, and it's all about the pipe in that case, as well as other potential strips of capital. So it's just a part of it. So at the end of the day, we end up having what's known as founders shares, and that we get to run a whole nother session on that. But we end up with a chunk of the going forward company for having put it all together, sort of for being the producer of the movie, as I like to call it. So that part is negotiable. In general, it's 20%, and but again, it's negotiable.
Thanks, John, for taking a stab at that. All right, we have another question here. I'm going to see if I think Steve might be able to take a stab at this one. Do investment banks still play a significant role in the deal?
Yes, they do, and I might weave it in with one or two of the other questions as well. Yes, investment banks play a key role. There's the investment banks on both sides, and so the fees I was talking about, primarily, a lot of it is the investment banks. They help raise the private placement. They help us structure the deal, and they also help guide the company in terms of its, how it presents itself to investors. So it is they do play a big, significant role, and their fees are. Some of them charge similar to what's an M&A fee, and others charge more what's a private placement fee, and others charge some combination of both. But there's usually banks on both sides. I did want to clarify kind of two other things as well, just based on one of the questions. So even though it is a merger transaction with the SPAC, going back to my example, you've got $1 billion value company, and the SPAC is $200 million. Even though the SPAC is acquiring the company, it really, just rough math, will only end up with 20% of the company, and the existing investors will have the other 800 million of equity in the public company itself. And so that if you're a private company, you really can think of the SPAC as a way to just raise the $200 million and to end up with a public company vehicle, as opposed to selling your company to that. The flip side of it is on the other side is if the SPAC is looking to buy a company, the question is in terms of the different roll-ups, why are you not seeing as many roll-ups? One, because it's you've got a SPAC who, by its charter itself, actually has to buy a company that has at least 85% of the value. So a $200 million SPAC can't go out and buy a $10 million company and use that to roll up and do some good acquisitions. So the SPAC itself has to look for a big enough company itself to do the acquisition. And then post SPAC transaction, it's just like a public company. At that point, it can go out and do, you know, any number of transactions with its public currency. And so that's the goal of some of these SPAC transactions, is to actually start with one good solid base of a company, take that public through the SPAC transaction, and then go out and buy a bunch of other companies and roll them up.
Thanks, Steve. All right, we're almost getting to the top of the hour. I'm going to try to get to everybody's question here. Let's see, we have another question here about the cost, like the total cost. Maybe Frank, do you want to take a stab at that? What's a good budget for? I mean, I guess you didn't do a SPAC. Anybody want to take it?
I couldn't begin to answer that. And if you want to know the budget on an IPO, actually, Scott Burrows, I might hit you up. It was a lot. I don't remember off the top of my head what we spent, but it was multiple millions of dollars to do the IPO.
Yeah.
Not to mention the fees then that we paid the bankers too on top of that.
Yeah, John, do you have a gauge on total costs with legal, accounting, marketing, and everything on a SPAC?
Sure. Well, for those of you that are considering raising a SPAC, there's a fairly well-known formula of 2%. You need to have 2% of the total amount you want to raise plus $2 million for working capital. I think Stephen would agree. That's sort of the general working number for those of you thinking about raising. The de-SPAC transaction is very much, as Frank said, very akin to an IPO. There'll be fees on our side as a SPAC. There'll be fees on your side as the target. And then, yes, there's SPAC-a-palooza, as our counsel says. Then there's fee-a-palooza. It seems that between the underwriter, the D&O insurance, you've got the printer, you've got the folks who are keeping your money in escrow, you've got the bankers, et cetera. It really does add up. And the folks, the providers definitely earn their keep in those cases. So as for a number, I think it also depends on how much you're trying to raise and how large the merger is. These things are fairly well documented.
Great. Thanks, John, for that. All right.
Sorry, Laura, I guess the one thing I would add just on this whole question about the fees is, you know, especially if you're working with reputable firms and an experienced team, you know, there's a market rate for everything, right? And so you should be paying about what's market. And as long as you're paying about what's market, don't worry about the fees. What's important is the $150 million that you're going to pull into your company that's going to allow you to create a whole lot of value with that. Right? If you can't use that $150 million, don't raise the money. If you can, it's a good investment regardless of what the fees are, right? Just don't overpay versus what everyone else is paying. And I wouldn't worry about it much more than that.
That's a great point. Good point. All right. Well, now that we got to the top of the hour, I want to start by thanking our panelists. Thank you, Frank, for sharing your insight. Thank you, Lars, for your time and sharing your insight on D&O. John, thank you for joining us.
You're spectacular, Laura, spectacular.
John Lockhart on the media side. Steve, thank you for your legal advice. And Trent, always for the audit side. And John, on your experience on SPACs. Thanks for sharing that with us. And you know, if you're happy holidays to everybody. We hope 2021 is much better than 2020. And if you would like to join us on future CFO focuses, you can check us out at www.cfofocusforum.com. All right, well, that does it. Thank you so much, everyone. Have a wonderful night.
Thanks, Laura.
Thank you.
Good job.
Good night. Please reach out if you have any follow-up questions.
Thanks.
Thank you so much.
Bye.